If you're looking for an option to park your short-term money for up to 6 months, then you may want to consider looking up arbitrage funds. In the last few months, arbitrage funds have begun delivering decent returns, and it's worthwhile, therefore, to see what is the opportunity being presented here. In the December expiry, the Nifty 50 index was lower by 1.59% compared with the previous expiry. The market-wide rollovers at the end of this series were at 91%, the same as the average of the last three series. The rollovers of the stock futures was higher at 93%, again maintaining the average of the last three series. The Nifty futures rollover was just a shade lower at 79%, again maintaining the trailing 3 months average. So there is more conviction in terms of individual stocks. This indicates that investors have also chosen to retain their positions because we're maintaining the average of the last 3 months, and we can also infer that the market sentiment as of now remains intact. The futures rollover for the December-January series started from 65 to 74 basis points and moved in the range of 52 to 74 in the expiry week, which compares with 60 to 80 basis points range in the previous expiry. However, on the last day of the expiry week, the roll levels moved in the range of 60 to 80 basis points. The average roll levels across stock futures was 60 to 74 basis points, with next month's fresh arbitrage happening at 65 to 80 basis point spread in the expiry week. The significance of this data set is that the range at the higher end is being maintained, and it is likely to continue going forward as well. For the SBI Arbitrage Opportunities Fund, the roll spread on the arbitrage book, after considering dividends announced or expected, is 8.45% annualized for the December-January series. On expiry date, the allocation to equity stood at 71.44% and 28.56% was the allocation which was to debt and money market instruments. Now, over the last 6 to 9 months, the team has been conservatively managing the debt portfolio of the arbitrage fund, and they have maintained relatively low duration. And this strategy paid off as the fund was largely shielded from the parallel shift in the shorter end yield curve in the last 1 year. While we are closer to the end with respect to policy hikes, the short end of the curve is likely to be volatile during the next quarter. The reasons include the high probability that there could be another 25 basis points hike in the February policy, along with moderation in the system liquidity. Further, given the strong credit growth, CD supply from banks are expected to keep short-end rates under pressure as well. The fund manager also does not intend to change the fund's debt positioning during the month and will abstain from increasing the portfolio duration. At present, shorter-term money market assets continue to provide relative value based on the scheme characteristics and the risk appetite. The three key factors which are likely to impact spreads in near term include the Q3 earnings, the union budget on the 1st of Feb, and the global COVID situation and how it develops from here on. Remember, high volatility, if any, will provide an opportunity to unwind the existing positions and allocate the same in other higher spread stocks or short-term debt instruments. Thanks for watching. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.